I think that the first question just brings us back to what Lyndon LaRouche was discussing after he was briefed on a meeting that you and Debbie Freeman had, and his response was that we really have to pull up this history of the takedown of Glass-Steagall. So if you could just discuss a little bit what happened in that meeting, what you told Lynn, and what his response was.
Well, what Debbie initially put together from some discussions and meetings that she had with some people up in New York was that the circumstances around the impeachment targeting of President Bill Clinton, 1998, 1999, can only be properly understood in the context of a 15-year drive coming from some of the leading financial institutions on Wall Street with obvious backing from their counterparts in the City of London to take down and destroy the Glass-Steagall system, which had been established in 1933 by Franklin Roosevelt as one of the cornerstones of the turnaround of the great economic crash that followed the stock market collapse of 1929. Basically, Franklin Roosevelt, through the Glass-Steagall Act, created an absolute wall of separation between commercial banking, which was urgently required for the functioning of the entire economy. These commercial banks basically are depository institutions. They take deposits from customers, they issue commercial loans, they issue personal loans, and at every level of the economy, things function through the commercial banking system. On the other hand, you've got investment banks, you've got insurance companies, and now in the recent several decades, you've got other exotic phenomenon like hedge funds and private equity funds that didn't even exist back then. But the whole idea of Franklin Roosevelt was that you've got to break up the big banks. You've got to break up a system in which depositors' funds could be speculated on by bankers who were engaged in this entire range of activity. So in 1933, the Glass-Steagall Act passed, and within a very short period of time, commercial banks were completely separated out from all of this other speculative activity. And from that moment on, Wall Street had been absolutely committed to the idea that Glass-Steagall had to be crushed. And this process really began in earnest in 1981-82, when you had the first big phase of the deregulation of both the domestic banking system and the relationship between U.S. banks and banks overseas. And you had the Graham-Rudman bill that passed in 1981 or 82 that really got the ball rolling. And so in 1984, J.P. Morgan, the most British of all of the big Wall Street banks, had an internal research project. And the question was, how do we launch a campaign to successfully repeal Glass-Steagall? And at that time, Alan Greenspan was a director of J.P. Morgan. He was in on this project. And before the end of 1984, they had produced a pamphlet called Rethinking Glass-Steagall. And of course, from their standpoint, the rethink of it was, how do we get rid of this thing? It's been an impediment to our ability to literally loot the economy and to also have access to the kinds of household savings that are involved in commercial banks. How are we going to take that money and use it for leverage speculation? Now, Alan Greenspan was there at the very beginning of this. And of course, from an ideological standpoint, Alan Greenspan was a big fan of Ayn Rand, who was a philosopher who basically preached greed as the ultimate virtue. And Alan Greenspan was personally infatuated. He was a protege of Ayn Rand. I'm not going to speculate about how close their relationship actually was, but he was clearly one of her key acolytes. And so the idea of greed as the ultimate virtue informed everything that Alan Greenspan did. And so the breakup of Glass-Steagall, in a certain sense, from minimally his days at J.P. Morgan, was kind of a life mission. Now, in 1987, Alan Greenspan was appointed chairman of the Federal Reserve. And suddenly, for the first time, they had somebody in place who was totally committed to the idea of breaking down the entire system of barriers that had been erected by Franklin Roosevelt as a way of curbing the power of Wall Street and putting the emphasis on real economic growth in the interest of the general welfare of the whole population. Wall Street wanted to kill it. So with Greenspan at the Fed, they began a steady process of erosion of Glass-Steagall. Now, in 1954, 55, 56, somewhere in there, Congress passed a law called the Bank Holding Company Act. And it was ostensibly a regulatory bill that placed certain prohibitions and clarified restrictions on interstate banking. But it also had a few loopholes. It gave a certain amount of discretion to the chairman of the board of the Federal Reserve to allow him to permit certain kinds of investment banking activity on the part of commercial banks. And so for a long period of time, commercial banks were permitted to do 5% of their overall activity in areas that were really investment banking, setting up bond issuances for corporations, things like that. Under Greenspan, that 5% figure was increased to 10%, and eventually, under Greenspan's discretion, banks were given authority to earn 25% of their total revenue through activities that are really investment banking activities. So the barrier was broken, but still there were formal restrictions because Glass-Steagall was the law of the land. And ultimately what that meant was a commercial bank could not be partnered with an insurance company, with an investment bank. There could not be under one bank holding company roof these various different elements. It was a decisive wall of separation. And of course, from 1933 up until the repeal of Glass-Steagall in 1999, we went through a 66-year period where there was never a systemic crisis within the commercial banking system. Why? Because bankers were restricted. They couldn't speculate wildly with depositors' funds. And of course, you had also from Franklin Roosevelt, the Federal Depositors Insurance Company, which was an insurance program that basically guaranteed up to $100,000 per individual account in deposits by families, by individuals, by companies, so that even when an individual bank might have gotten in trouble, people knew that their money up to $100,000 per individual account was protected by the federal government. And so there was no temptation for there to be runs on commercial banks, for people to panic and pull their money out, as was the case after the 1929 crash, running all the way up into when Roosevelt came into office. So these walls of protection under Glass-Steagall meant that bankers were restricted and regulated, and we went through a long, long period where we had the most stable commercial banking system in the world because of what Roosevelt enacted. So Greenspan, as chairman of the Fed, had broken down some of the barriers, but there was still a fundamental impediment. An insurance company could not own a commercial bank. A commercial bank could not own an insurance company or a brokerage house. And so this was where things stood right up until about 1996, 1997, at which point Travelers Insurance Company, under the chairmanship of a guy named Sanford Weill, made a move to merge with Citibank, one of the largest New York City commercial banks. And it happened that Travelers Insurance Company also owned a brokerage house called Smith Barney. And what happened is that Greenspan gave a temporary waiver and allowed Travelers to take over Citibank in a merger that created a single entity that had a commercial bank, that had a brokerage house, and had an insurance company all under one roof. And so basically, what Greenspan said in this waiver was that Sandy Weill and the others had a 2-year deadline to come under Glass-Steagall compliance, which would have meant that they would have had to have sold off various parts of it. It would have disintegrated the deal that was intended to break the back of Glass-Steagall. So from the moment that the Citicorp Travelers merger was granted that waiver and given a 2-year period to come into compliance, it set an absolute deadline for the repeal of Glass-Steagall. And so the Citibank Travelers combination took a leading role, but with the clock ticking down, every major Wall Street interest began pouring massive amounts of money into the repeal of Glass-Steagall. And so, under the deadline, in November of 1999, President Clinton, and we'll get to the issue of his impeachment in this context, signed into law the Graham-Leach-Bliley Financial Modernization Act, which repealed Glass-Steagall. It did many other things as well, but the crucial thing is that it repealed Glass-Steagall, meaning that bank holding companies could now merge together commercial banking, investment banking, insurance, and then, as I say, it got into more exotic things like hedge funds, private equity funds, all kinds of institutions, all under one roof, the money all commingled, no protection beyond the FDIC limits for depositors in commercial banks. It was an absolute unmitigated disaster. And I think there's two things that can be said just in summary. Number one, this never would have been possible but for the fact that Alan Greenspan was at the Federal Reserve. He was the driver. He was, in a certain sense, the key inside player who willfully broke the law. You could say that he bent the rules and, quote, liberally interpreted the latitude he had under the Bank Holding Company Act. But in fact, he broke the law. He ripped up the Constitution and created the conditions for this Citibank Travelers merger to happen completely illegally and to then set the clock running on a very precise deadline for the repeal of Glass-Steagall. So without Alan Greenspan, none of this would have happened. We wouldn't be having this discussion today. We wouldn't be talking about the 2007 and 2008 bank collapse, and we wouldn't be talking about an imminent blowout of the entire international financial system, which is what we're facing at this moment. So Greenspan was one crucial thing. The other crucial thing is that were it not for the fact that President Clinton was completely distracted by the impeachment process, this would not have happened. I don't think that were he in control of the presidency, were he even conferring with his Treasury Secretary, Robert Rubin, that this operation would have been successful. And in fact, in 1998, President Clinton more or less sealed his own fate by going up to New York and giving an address at the Council on Foreign Relations, in which he said that there had to be a new global financial architecture because speculators had hijacked the current international financial system. And he was working very closely with Treasury Secretary Rubin to create an organization made up of representatives of 22 sovereign governments, the G7, the advanced sector countries, and the G15, the leading developing sector countries, put together a series of conferences in Washington, D.C., set up working groups, and they were working on a new global financial architecture. I can't say that they were prepared to go as far as Lyndon LaRouche's call for establishing a new Bretton Woods system that would have involved a return to a fixed exchange rate. But they were headed in that direction. And so at the very moment that Greenspan and Wall Street were going in for the kill against Glass-Steagall, you had at least an impulse in exactly the opposite direction, to go for greater international regulation and cooperation among sovereign governments to curb the power of short-term speculative capital, which was running havoc on the planet. You had an Asia crisis that was really just the beginning eruption of a global systemic crisis that we're still living through today. So were it not for the impeachment, there's a very real possibility that President Clinton would have pushed back against the Greenspan effort to kill Glass-Steagall, and that we might have actually had something approximating a new, more highly regulated international system back in the late 90s. The impeachment was strategic. It was targeted against the president because they wanted to make sure that he didn't go anywhere near the direction of what Lyndon LaRouche was calling for with his new Bretton Woods proposal, which was initiated in January of 1997 and became a major organizing thrust of the entire LaRouche movement for the next 2 years.